Well, actually, quite a bit has gone on. First of all, look at the strength that we've seen in gold. In fact, gold stocks are already up about 11% in the first 4 trading days of the year, although today, the fourth day isn't even over yet. We'll see what happens. But we've seen some incredible strength in gold mining stocks. They have continued their stealth bull market. Many of these stocks are up 40, 50, 100% from where they were 4 or 5 months ago. So this is a big move. And during that same period of time, by the way, the NASDAQ has actually gone down. So the stocks that everybody owns are going down, and the stocks that nobody owns, except a few people, are going way up. And they're going up in relative obscurity, which likely means the rally is going to continue, because as long as it's not on anybody's radar, you don't have to worry about any kind of meaningful pullback. So I think it's very encouraging as a gold investor, as a gold stock investor. Also, the dollar is starting off the year weak, which is the way it ended the prior year. And I think 2023 could end up being one of the weakest years ever for the US dollar. I think a lot of people piled into the long dollar trade in 2022 based on Fed tightening and the idea that the Fed was going to continue to ratchet up rates to bring down inflation, and that got a lot of people into the dollar. I think what's going to get them out of the dollar in 2023 is the realization that the Fed is going to give up its inflation fight, not because it wins, but because it loses. And it's going to focus attention on the economy, which is going to be in an even deeper recession. And I think in 2023, the recession deniers are going to finally have to admit the truth. And there's going to be a lot of pressure on the Fed to stimulate the economy, especially when we see a big increase in unemployment, which we haven't had yet, but which is coming. But the only stimulus the Fed has in its tool chest is inflation. That's all it's ever had. The only thing the Federal Reserve does when it wants to stimulate the economy is create inflation. Except the problem is now that inflation is the problem, and you can't solve a problem by creating more of the same problem that you're trying to solve. Gold stocks are going to do very well in an environment where the Fed is pivoted. And even if the Fed doesn't make a full pivot, it doesn't have to cut rates. It just stops hiking them. But I think more importantly would be quantitative tightening. If it slows down the pace of QT or actually goes back to QE, that is going to be, rocket fuel, I think, for gold. Because, the markets were pricing in this big reduction in the Fed's balance sheet. And I think the Fed is going to be even less successful shrinking it this time than it was the first time it tried. Remember, that when the balance sheet got to 4 trillion, they were supposed to bring it back down to 1 trillion. And I don't even know if they got below 3 trillion before they cranked it up to almost 9 trillion. And it's going to be harder to shrink a $9 trillion balance sheet than it was to shrink a $4 trillion balance sheet, especially when they're trying to shrink it in a much more highly levered up economy. The tech stocks are not cheap. In fact, despite a rather significant decline, they remain expensive. But I don't think that the next bubble is going to be in the same assets as the past bubble. So when the Fed tries to reflate this economy, I don't think they're going to reflate the tech bubble. We had a tech bubble 20 years ago in the late 1990s, and then we had another one more recently. But I think that this next time, the money is not going to flow into that sector. And I think one of the main reasons is going to be inflation. I think that tech stocks were part of the low inflation story. Low inflation meant low interest rates, and that meant that companies that were growth oriented, that weren't expected to deliver profits until many years into the future, when interest rates and inflation were low, investors were willing to wait, and they were willing to pay up for the prospect of a big payday in the distant future. But now, with the cost of waiting so much higher, not just the nominal interest rates, but the inflation rate. If money is really losing value much faster than 2% a year, you don't want to wait 10, 20 years to get your money. Who knows what it's going to be worth by then? So I think investors are going to be looking for stocks that can show them the money right now. So it's not companies that are promising earnings in the future. It's companies that have earnings right now and can deliver those earnings to shareholders in dividends, and dividends that can go up with inflation. People are going to be looking for the stock market as an inflation hedge to get out of bonds, to get out of cash. And they want real companies. They want companies with pricing power. That's important in an inflationary environment. You have to be able to raise your prices without destroying your sales. Now, a lot of companies are not going to be in that position. When they raise their prices, their buyers are going to go away. And in fact, even if they don't raise their prices, if your customers are spending a lot more money on food, on energy, on insurance, on rent, on taxes, and they have nothing left over, then it doesn't even matter if you cut your prices. You don't have any customers. So a lot of companies that have been living off of the discretionary income of the consumer, especially when the consumer had a lot of home equity and could tap into it, or had the ability to buy now and pay later, had all kinds of credit, they could run up their credit cards. A lot of companies lived off of that. Well, they're going to die by that as well when the consumer can no longer avail himself of that credit. The last couple of times the Fed was able to orchestrate the pivot, right? It did it when inflation was 2% or less than 2%. And that provided the cover for the Fed. Hey, it's okay to do this because we have really low inflation. In fact, it's too low. And so we can kill two birds with one stone. We can stimulate the economy and get closer to our 2% inflation goal, because we're going to stimulate the economy with inflationary monetary policy, which they claimed we needed. Of course, we needed it like a hole in the head because we don't need 2% inflation. Plus, it wasn't even 2%. That's only because they lied about it. They had a lie to get it to below 2%. It was actually probably 4%. And now, of course, it's double digit, although they won't acknowledge double digit because of the way the index is rigged. But my point is that let's say that we're back in recession, maybe even a financial crisis. You know, we're seeing it in a small scale play out right now in crypto and blockchain, right? You're seeing all the dominoes, one company after another going bankrupt, freezing accounts, because everybody owed everybody else money. And there was so much counterparty risk, and it's this, you know, and so everything is kind of imploding. But so far, it's kind of isolated, you know, to the crypto. Yeah, you know, you got Bed Bath & Beyond came out yesterday and they're filing bankruptcy. Of course, that was a meme stock, got to $30 a few months ago. Now it's barely $1, right? But, you know, you're mainly seeing this, you know, collapse in crypto, although there's still a long way to go down because, you know, Bitcoin is still trading above 16,000. So the people are still in denial in, you know, in the HODL gang. But what I think is going to happen is as higher interest rates work their way through the economy, you're going to see more problems in the credit markets blowing up, and it's going to be outside